That picks up pretty well. Welcome to Startup Week. And today we've got Ryan Roberts, Dallas Deal Terms, Seed and Venture Capital. But before we get there, I'd like to thank our sponsors, of course, for making this freely available to all of us. We have Chase, Downtown Dallas, Inc., Vela Wood, Touch Titans, Dev Mountain, Kirkus, Kratos, and many, many more. And a special thanks to the Basecamp here and Chase as well. If you're using social media, be sure to use the hashtag DSW16. Okay, so that's my bit. Now I'll introduce our legal track leader, John Lindsay.
Thank you. My name is John Lindsay. I'm a patent attorney. I recognize a few faces from my presentation yesterday. So anyway, as he mentioned, yes, I am the track leader, and part of my goal was to get relevant subjects to you guys. And so part of what made me ask Ryan to participate in this is that as a patent attorney, businesses are often formed around the intellectual property / patent that's being filed, and usually I'll get kind of blanket statements like, I want to maintain control of my LLC. I want 51% control, and I just hear kind of stupid, kind of uninformed statements about that as well too, and that's the only element of a deal that they're concerned about, and I say, hold on, you need to talk to somebody to help you understand a little bit more about the deal. It's not just 51%. There could be issues such as, having directors inserted on the board and other issues like that, so it's a lot more involved than just having, quote, 51% or majority ownership or something like that. So anyway, that's why I thought this topic would be useful to you guys. So I'm going to turn it over to Ryan.
Thanks, John. Hi, everybody. Ryan Roberts. I always say, what do I do? And I'm a startup lawyer. I'll call myself a venture attorney. If I went to the Dallas Bar Association, I wouldn't tell anybody I did that because they wouldn't understand what I would do. I'd say I'm a corporate securities attorney who represents emerging technology companies and venture capitalists in financing transactions. So that's why it's startup lawyer. I think people think I just started. I've actually had my own practice for a little over 10 years now. Partner at Roberts Foster LLP. We're a boutique shop in Southlake, Texas, which some of you, this is a bubble out here, it's a bubble out there. I think a lot of you think that the furthest west you've been is Terminal D, and then it's Los Angeles. So there is something between Los Angeles and Terminal D at DFW, and that's where we're located at. We're pretty lucky. We definitely have a great client base in Texas, but a good majority of the clients or the deals that we work on are outside of Texas. And I think that gives us a pretty good perspective on not just deals in general, but if people are doing deals here now. And Dallas used to be much more of a closed environment, meaning that if you were a Dallas company, you pretty much got funding from Dallas-based investors, or else you moved. There's a lot of successful companies that were Dallas companies that essentially had to move and attract venture funding outside of here. Probably the biggest example of that is a recent example is Ustream. They started out here. They started their first prototype in Deep Ellum and couldn't get local funding and went out to the Valley and sold, I think, a couple months ago. So that's a little bit about what we do in the history. And so I think the purpose, if I wanted to help today or provide knowledge or whatever I could today, is if you're a company or thinking of raising money here or just want to know what the heck is going on here, because we've had a sort of a new resurgence or a surgence of new investors, VCs. I know there was a panel, I think a couple hours ago that started, or maybe just finished 20 minutes ago. We have a couple VC clients on that panel just to help you sort of sort through all this mess. So how many of you are have raised capital recently, looking to raise capital? And you don't have to raise your hand if you don't want to. I'm not judging. I'm just trying to get a flavor thing. All right, cool. Can I ask, and I say this is I should probably bring up my next slide first. So I was what quote should I have? And if you know me a little bit, I definitely don't sugarcoat anything. And I think people from Dallas Morning News or used to be Dallas Business Journal will call me up and get the contrary quote, I'll call it. And I'm happy to give it, but really what I'm trying to do is provide some realistic perspective about what's going on. And hopefully that comes off, could be, oh, he's a downer about the community or downer about things in general, but I think if you actually talk to people, they're very excited. It's amazing that the skyline was all orange yesterday, but people are still having trouble on the ground here, on the street, trying to raise capital from people. So this hopefully will I'll say keep it real, but we'll definitely, I call it, this is like the safe zone, or we can say what we want in here, except I think Danielle is live tweeting it, and this is being recorded, obviously, so maybe it's not as safe as you think. And that is my bio slide. Quick overview, just some of like the seed round, venture capital round structures. What are the most common economic terms? What are the most common control terms that you see in both seed and venture capital financings? And then very long bullet point, what to expect in rules to raise capital in Dallas, AKA what the heck is going on in Dallas? That's too long, sorry about that. And then hopefully some Q&A, and if you want to ask a question during, like totally fine, I'll answer it and we can have a good discussion. So the first part to start is like, what is seed financing and what's venture capital financing? The lines have definitely blurred the last 3 to 4 years. Like historically, a seed financing was, oh, up to your first $1 million. That's seed. Everything after that is a Series A round or it's a venture capital round. But due to like the good times they say have gone on with startups, seed rounds, people are doing like a $5 million seed round now. I remember the first time this sort of happened to me was 4 years ago. We had a client in Y Combinator, and they said, oh, we're doing a $4.5 million round. And I called it their Series A. And they're like, that's not our Series A. What are you talking about? It's a seed round. So there's some optics there, and that's sort of come to Dallas. If clients are raising $2-3 million, it's not, and even if they have a venture capital fund in the round, they don't want to call it their venture capital round or their seed round. So the lines have been blurred there. And why does this matter? From a structural standpoint, terms tend to differ between a seed round and a venture capital round, or let's call it a Series A. So from a strategic standpoint, it's been more beneficial to some founders and early stage companies now if they can categorize their round successfully as a seed round or a Series A round, or a seed round instead of a Series A round. And so the next slide is like what these structures are. So you're doing your seed round, and it could be anywhere from $1 or $50K, and I think the highest I've seen is like 5 million. After that, it gets kind of ridiculous to say this is our, $12 million seed round. No one really believes that. But venture capital rounds, anywhere from 1 to 100 million. Obviously, you see some big rounds that the unicorns do over 100 million, but primarily it can start from 1. Now they're, let's say 5 million and up, but they still happen at 1 million. Ironically, in Dallas, you might have some investors that will say, hey, let's do the full-on venture capital round at 100K. And let's do the full-blown venture capital documents, which will cost you like 40K to use. Probably not the best investment is to sell off like 12% of your company to cover legal fees on that. So that has happened out here, not as much recently, but it happens. But so the most common structures is first convertible notes. Is any of you familiar with convertible notes? Basically, it's a loan to the company that an investor gives you with the idea that in the future, some trigger, it will convert into equity at your next round, we'll call it. There's usually economic incentives, obviously, for that. You get a discount. So just quick example, I'm coming in, your next round is valued at $2 million. I get to convert as if I invested at $1 million valuation. The next portion is convertible equity. That's the same exact thing as convertible debt, except it's just not a debt instrument. It's convertible debt without interest, without a maturity date. Very sort of newish, founder favorable way to finance your company. There's some docs that are out there now, like Y Combinator put out the SAFE documents. 500 Startups put out the KISS documents. We've seen those used here. So I think a lot of practitioners or people say, oh, that's just what they do in the Valley. That's all that magic they do out there. But it happens here. We've had clients successfully use it. We even had some of our VC clients invest in those types of instruments. So don't let people beat you down and say, oh, you're in Dallas, you can't do that. Venture capital round, preferred equity, full-blown Series A round, hoist of economic and control terms. I don't have a whole lot of time, so I can't go deep into them, but I'll go into some of what they are. Yeah. Yeah, so yes, what's the typical price cap on a convertible note? Price cap on a convertible note is, it used to be, and I'll give a quick background on it, so how we got to price caps. It used to be you just got a discount on the next round. So like 8 years ago, all convertible notes you get a 25% discount on the next round. Well, what happened? It got a lot cheaper to run and develop a startup, right? You're not spending like $1 million on a server anymore. So these things went longer and longer. And if you waited 2 years for your next round, your investor's like, wait, I was in 2 years ago when you guys were like, a guy and a girl and that was it. Now you have like 30 people and all I get is a 25% discount. So they said, hey, we want to create what's the maximum valuation that I will convert in your convertible note. So instead of just a 20% discount, it will say something like, worst case scenario, I will convert at a valuation of X, and X is the price cap. And so you asked, what's the typical one? I've seen them as low as $1 million, which is like really low. I think if you just ask me what typical caps are, anywhere from 2 to 5 for like true early stage. They can go a little lower. I saw a deal across my desk that had a cap at like 25. So those are definitely like the outliers, like the $1 million is the outlier, the 25 million is the outlier. If I had to guess, I'd say 4 or 5. So these two types of deal terms, economic control. Economic is obviously like the money terms. And the biggest deal term is valuation, and there's pre-money and post-money valuation. Does anybody not know what a pre-money valuation is? That's okay. So everybody knows. Okay, Bradley doesn't know. Yeah, okay. Pre-money valuation is what's the value of your company immediately before the investment. Post-money, it follows, is what is the valuation of your company immediately after. So if I'm like, say I'm the VC, Bradley, $1 million in your company at a $4 million pre-money valuation. That means post-money is $5 million. And for that 1 million, I can do math, 20% of the company. It's 1 divided by 5. And I had this tweet I sent out 4 months ago. It's sort of embarrassing because there's only like 3 likes on it, which is I think really low for a tweet. But I put is like, I'll watch Shark Tank when they stop talking in post-money numbers. So if you get anything from this presentation, realize that Shark Tank just thinks you're stupid. And they say, if it's Robert or whoever says, so tell us why your company is worth $5 million. Well, they're talking in post-money numbers, not pre-money numbers. So I'm waiting for the first entrepreneur on the show to say, I don't think, so for Bradley's example, Bradley, why is your company worth $5 million? Bradley would say, no, I think it's worth 4. It's worth 5 after your money's in. So that's one thing they just sort of mix up on the show. And I think a lot of founders sort of mix that up too. That's definitely one of the big economic terms. That's probably like the big term that everybody like worries about the most, price cap. And price cap technically is an evaluation, but then there's several ways that an investor can affect your pre-money valuation. And by affect, I mean, let's ultimately reduce what we say we're giving you. And so there's terms like a liquidation preference. So I can say, in that same deal with Bradley, $1 million. Typically, the liquidation preference is like 1 times my money. It's used as like downside protection. Some people, you'll get a term sheet, and we've seen term sheets out here that say 4x my money. So if Bradley sells the next day for $5 million, I get 4, the founders get 1. Was the valuation really $4 million? No, it was a lower effective. That's one way to do it. They can do it obviously through like payment of dividends or dividends that accrue, anti-dilution, and then the option pool. There's a lot of other ways to do it. Those are the main things. There's control terms. And I think most people think, as John said at the beginning, I don't have control. As long as I have 50.001% of the company, I have control. And that can be true, but I can create a company where if I give Bradley I'm using an example. You want to go next? Okay, Bradley, I'll give you 9 million shares. I'll have 1 share, and I can create control of the company with that 1 share. So to think of it purely from a numbers perspective is a little bit erroneous. But most people, when it comes to raising a round, like what does control mean? They sort of check the box, okay, they're not taking more than half of my company, which some investors may ask for, which is way too much in an early stage, or it just means you're taking like too much expensive money at the time. But it's a board seat. And I feel kind of like in Dallas, a lot of startups, not my clients of course, they sort of treat their board seats as like startup swag. Like, let's just give it out. I'm in a startup. Oh, here's, like board seats are not koozies. That's what I feel like a lot of people are like doing out here. If you look at like a lot of the startups out here, look at their pages. It's like, there's like 1 founder and there's like 5 other people not working for the startup. And they've raised maybe like $500,000. I don't know what happened, but there's nothing like prestigious about having a bunch of people on your board. Technically, that's what an advisory board is for. We'll talk a little bit about that later. The other way to control your company is with protective provisions or covenants. That's how I could control Bradley's company with just 1 share. I could say, Bradley gets common class A, I get preferred class, whatever. But for all these things, Bradley has to get the vote of my preferred share to do it. So that happens a lot, or that's a way that people can get control with not being on the board. So there's a board vote. For a lot of things, there's a shareholder vote or a covenant that you get the consent of a group, not just all of the shareholders, but a subset or a group thereof. Economic terms in Dallas, I mean, we see a lot of deals. Like the pre-money valuations aren't as bad as they were. Before it used to be like, hey, let's raise $1 million and we'll give up just 65% of our company here. I think it's sort of trended towards like the normal now, where we don't really see anybody giving up more than 25% of their round. 25% is probably a good litmus test to know, like, if your round's costing you more percentage than that, it's probably either you're taking too much money or the deal is just not right for you at the time. We're not really seeing any like offensive liquidation preferences. What I mean, they're not using the liquidation preference as a downside protection. They're using it as a way to sort of like hoodwink you into thinking I really value it $4 million when really I was effectively did it a lot lower. We're still seeing an option pool of 10% or more. How much time do I have? A lot. In rare occasions, do we see like accruing dividends? I think dividends are just pretty lame. They're just, you should not have to like pay your lawyers to like put those into your charter to do it. Like, because this is all about price. Just talk about price. If you're dealing with investors, just talk pre-money. Everything else should be standard, like 1x participation, well, non-participating liquidation preference, like no dividends, no accruing dividends, and a decent sized option pool. Option pool, if you don't know, is like a set of equities set aside for prospective future hires, consultants, outside board members, advisors, et cetera. And so I guess that's sort of my take home, which I mean, I guess I put there for like my notes. I guess you can read it too. Like, don't let investors use that against, like, don't let me use that. Just talk price at the high level. As far as control terms of Dallas, here's where it gets funky. So my question is, does anybody know how Dallas angel investors get to heaven? Anybody? Anybody guess? By the amount of boards they've been on. No, that's not true. And I think they're slowly learning that over time. And I was trying to figure out, like, what's the cause for all this control requests? And sometimes it feels like I'm watching Of Mice and Men, but instead of like Lenny squeezing a bunny, they're squeezing like my client. And I think it's because, frankly, like, they just don't trust the younger people to run the company. And sometimes they'll admit that, and sometimes they really won't. But I think they're really good, sophisticated investors will only invest in a company because they believe those people that are there right now will be able to implement or basically do what they say they're gonna do in the business plan. So regardless, like, be prepared if you're raising money here to sort of potentially fight for your rights. That wasn't like a Beastie Boys reference, although that's in my head right now, and you're too young to know that means. But so one of the things we hear is like, oh, like, you're doing a Series A, so be prepared not to have board control anymore. We've probably done like 40 or 50 Series A rounds. I've never had a client after Series A give up board control. Worst case, it's a neutral board. And just for example, me, Bradley, and you as the independent that we mutually select. Like that's worst case scenario. And I said prior to Series B, it could be even like Series C or Series D. Now, if they're afraid, they don't trust you, if they really don't trust you, they probably shouldn't be investing in you, right? One. But sometimes you don't have the option to say, you don't trust me, I'll go find somebody else to invest in your company. So what can you do? Like you can use other methods to provide comfort to investors. So there's like information rights, there's board observer rights, there's some protective provisions that make sense and are reasonable in case anybody tries to use this against me in the future. But there's other ways that you can sort of provide provide comfort to your investors that you're not, I'll call it a young kid, or you don't have experience, or because you haven't taken a company public before and they have, that you shouldn't give up control. Like you don't need an over babysitter to do this. They should be trusting in you to do it. And I think our clients realize that, our VC clients realize that. They'll say, oh, I totally trust this guy or this girl 100%, so I'm in. That's it. So I did a quick thing of like never agree to these terms because these terms aren't as prevalent out here. They pop up from time to time. Like one is non-dilution rights. So, and I think this is more common out here because there's so many like real estate investors or oil and gas investors. And I actually asked, like, it's funny if you ask why. Like when you have somebody else with a strange term pop up on your term sheet, ask them why. It's amazing the response you get. Usually it's, well, if you have to come back and get more money and dilute me, that means you failed in your business plan. And so I've literally had to tell people up 75, or have an office on 75 saying, well, I know you typically invest in real estate and buildings, and if someone comes back to you with more money, it's usually cost overruns, and yeah, that usually goes on the promoter or the founder or whatever they call it in real estate finance or real estate investing. But in this case, real estate isn't just like the one block, not one parcel of land. Like we could do the universe. I mean, we have startups going to Mars now, or we have bots that are now going to Mars or whatever is going on out there. So that's one thing. Never agreed to like dividends that pay. Like you're just paying them like with their own money. Giving up control, and I put, unless you want to be like a glorified employee. And I say glorified employee because if they're really in control of everything you do, like that's what you are. You have a lot of equity, but you're still an employee. Like someone is your boss. And I don't think that's why you started the company to begin with. I mean, obviously down the line, it's great to have, I don't even know, pretend to know how much shares Zuckerberg has, but I'm pretty sure it's not a majority. I know he did something funky with like the voting control and all that, but yeah, like don't give it up so early. It's sort of sickening to see people do that out here. Again, liquidation preference greater than 1x, not as common anymore, but there were some term sheets, maybe from a fund that was upstairs, no, maybe not, that come out with like a 4x liquidation preference, or you gotta pay us back 5 or like 8x within 3 years. Like, what's that about? And then last one, like personal guarantee. I've had, it's funny, the only people who've asked for personal guarantees are the billionaires in Dallas. And I don't know why that is, because I guess they're trying to like, I always thought, are they asking this because they just don't want to say no and have that reputation? And they kind of want like the founder to say, oh no. But I told their lawyers, like, so I get it, like some of my clients may get an ulcer for being a startup, it's stressful, but let's not give them a heart attack, let's not promote heart attacks. Like no personal guarantees. This isn't commercial bank. And I don't even think SVB does that, right? Yeah, like venture debt financings, I've never seen a personal guarantee. So your sort of guide to raise capital in Dallas, don't let geography dictate your terms. Don't accept, I'm Dallas investor, we get crummy terms, and now there's like 3 people on my board that I didn't know, but hey, they have like pleated slacks, so it's amazing. Don't be too trendy as well. This is sort of like the counter. So a lot of people like will really follow what's going on in Silicon Valley and say, oh, Mark Schuster said, you should never do convertible debt rounds. Well, that's one opinion. Like, convertible debt rounds still work. Or if SAFE's a new one, you don't have to do a SAFE or you're not winning in your startup. And these rules are just suggested guidelines. So one of the rule is, if you're raising $1 million, you must give up a board seat. That's not etched in stone. That's nowhere. That's not in like Delaware's corporate law. That's nowhere. And then the other one is like, deal terms are not binary. So if someone says, give me a board seat, and you're just like, no, don't give me a board seat. It's not like a 0 or 1. Like, it's not 0, no board seat, 1 board seat. There's a lot of like middle ground. You just have to know like what to negotiate or what to ask for. And a lot of that's dependent on just asking them, like, what's your concern? And you get a lot of good feedback on it. And don't get upset that local investors take like forever sometimes. And usually they're taking forever because they're waiting for somebody else to make the decision for them. That's not as bad as it was, but how many of you have raised money out here and had an investor say, I'm interested, but let me know if someone else invests first? Anybody? Yeah, it happens all the time. That means, I think you should, close money when you can, but that's probably not like the optimal investor for you. You want people not to sit on the fence and wait for everybody else. You want people to believe in you. But it happens out here. It is still one of the biggest issues out here. I think even with some of like the VC funds, they still are suffering from that a little bit, but it's getting better. But also, like, be a good shepherd to all like the new money out here. So some are like maybe extremely like, what's the word? Amateurs about investing in startups, and try to take like advantage of them. Don't treat them wrong, because we need them to be a successful ecosystem, and the ecosystem's a lot better for raising capital like than it ever was. And I don't know, like back in the day and 16th floor, whatever, but that doesn't really matter anymore to Dallas. Like, we're way beyond that. So be a good shepherd. Everyone's on like the right path. What's my next slide? Oh, Plato's Allegory of the Cave. Does anybody know, can you give like a good summary of what Plato's Allegory of the Cave is? You may have read it like in 7th grade. Yes, it's what, the Matrix totally bit it, but they did a good job of it. But basically the allegory of the cave is, and I'm definitely gonna paraphrase and summarize, and you can't really see that, but there's a cave and there's prisoners in it. And their reality is these like shadows on the wall that, there's like some puppeteers. And that's all I know. That is their reality. And Plato asked basically, I think it was Socrates in the story, what if like somebody broke free and went out of the cave in the light? And the idea is, would it be amazing because like that's reality? Like, no, it would actually hurt. Like, they get sunburned, like they'd be so bright. They have issues with their eyes. So the idea is like, would they want to go back in the cave? And so I thought, like, how do I make this, like, I'm not gonna say like, so here's the idea. Who are the prisoners in this scenario? Raise your hand if you think it's the investors, or when I say it's the investors. Okay, is it the startups? No one's gonna say it's the lawyers. They're probably thinking, oh, the lawyers are the puppeteers now. Not to be, I think it's like, as a community, as an ecosystem, it's really all of us. And we need to like slowly like bring everybody out of this cave. And what I mean cave is this idea that we have like Dallas deal terms, accept super low valuations, give up control. Let's all go outside and see the light. We have sunblock, we have sunglasses, or blue blockers. I don't know why I thought of that. But, and so I think we're definitely getting there, and we're definitely much better off as an ecosystem, but there's like a long way to go. And events like this are great. This never would have happened. Well, I'm shocked this actually happened. So this is a great event to have. There's a lot of other things that are going on. But what's really gonna improve the ecosystem is hugely successful companies. Period, point blank, like that's it. And how do we get there? We let them grow here and stay here. So it's sort of like the motto here, like start here, exit here. But it should also be like start here, fund here, exit here. So I think that's sort of it. Time for Q&A. I don't know how long it is, but yeah, any questions now or after? Like Ryan Roberts, my Twitter handle is @StartupLawyer. I also publish like startuplawyer.com, and like shameless plug, the volunteer today uses it, so it must be legit. So thanks again for having me. Any questions, or do I need to like pass out a mic or? Yeah. If you have no questions, that's cool too, but yeah. I mean, honestly, I put that like right next to LLC. I mean, it just depends. I mean, obviously, I think you probably could do it. I've just never seen it. Not saying it can't be done, and I know there's like different like certifying bodies on that. Different states are accepting them, but I just don't know. Okay, so you want to compare Austin money, San Antonio money, I guess Houston money, to here. I mean, I think there was a report that like now, like here, we're doing a lot better than anywhere else, and I think that's good. Like we've always had the natural resources here in Dallas, like, and not just money, but like talented companies, entrepreneurs. Like I think someone told me that from like the panel upstairs, there's just like not enough like Series A fundable companies. Like that's bullshit. Like there's a lot. I see them leave all the time and get funding and exit and stuff. So they're here. We just haven't had the ecosystem, to support it. Various, like obviously Houston, probably not as enthused right now because of energy. I don't like to use like the price of oil as a reason why like venture should be good or bad in Texas. That's like the sort of opposite. And frankly, like if oil's down, maybe they should invest somewhere else. Maybe technology. I don't know. So that's it. I don't really have any numbers, but what I've been seeing, it is better now in Dallas. I think, but I don't think that's like going to be temporary. I hope it's not temporary. So, any other questions? I thought I saw Bradley Joyce.
So you talked about like convertible debt, convertible equity, preferred equity rounds. Can you talk about like what an entrepreneur should expect those types of financing to cost?
Oh, pointed question. I'm biased, but they should be like, I mean, any venture lawyer, any true startup lawyer knows that no matter how much money you raise, like you're bootstrapping it. So if I have a client that raised like a Series A at $8 million, that's not like money for the next like 30 years. That's like, 18 months, 3 years. But how much should it cost? Convertible instruments, debt or equity, obviously on the lower end of the range. You're not having to like redo the charter, and because there's not a ton of control terms in it, and frankly not a lot of economic terms in it, that's probably what I forgot to say, those are more favorable and quicker and reduce transaction costs, including like just the overall legal costs. Notes can be anywhere from like $1,000 to $5,000, including convertible equity. There's a lot of variables. I hate to give the whole like lawyer response, like it depends, but it really does. In that case, like seed round equity, again, it sort of depends what it is, but I expect to spend like 5 to 10K on it, on like a light preferred seed round. And what I meant by like light preferred, doesn't have all the bells and whistles of like a true like Series A round. And if you want to see what all the bells and whistles are, and I probably should put this on a slide for resources, go to like nvca.org. They have like model legal documents on this, and it's a lot of documents. There's a lot of stuff to go over. Or look at like their model term sheet. You can find like, you probably Google like the SAFE documents or the KISS documents or the SeriesC.com documents, but yeah, anywhere from like 1 to 10 should probably be for a true seed financing. Now, there are escalators on it, but there's a lot of assumptions to be made. Yeah, I think you had a question? No, so the question was, have we had clients who've, I guess, gone through a bad seed round and like had to fix it? Do you mean fix it because like just the term sucked, or because the investor sucked, or both, or? what we always strive to do is say, okay, if you need to close this money, and this happens, like they want some really random term, whether it's like non-dilution or some weird protective covenant, I always try to get an automatic termination of it upon your next round. Because that's sort of the biggest thing that can happen is you give up something that's not normal, a new investor comes in and says, what the heck is this? You got to get this like signed away. Now, most of the times you expect people to be rational and say, okay, I get it, there's a lot of money coming in, the valuation's up, I should be happy. But sometimes your current investor can be like, oh wait, I have some leverage, what else are you gonna give me? So hopefully any kind of good venture lawyer will see that as you're doing it, advise you like not to do it, but realize, okay, if you have to take the money, this is the only way you can keep going, maybe it's what you accept, but they'll work hard for that automatic termination ahead of time. So we don't have a lot of having to go back. Frankly, a lot of what you have to go back for is like a lost like founder you had and didn't tell us about. So, but yeah, it happens, but try to minimize it, yeah.
So you expect to see different terms for B2C versus B2B or different lines of business or industries?
There's really, from like a structural standpoint, there's no difference. I mean, I'm sure it affects like the valuation or what the prospective investor thinks your enterprise value or your exit potential is, but that's just sort of what like the pre-money is. And we don't really give huge opinions on that, besides like, hey, you're selling too much of your company at this round. So yeah, like he was first, and then yeah, sorry about that. Yeah. Yeah, so, and that's it, because a lot of the older investors here or older school people, they come from well, what's your last 12 months trailing earnings or whatever, and so they go, wait, why are you worth more than $1? Because you're bleeding money, right? There's no real way. I say just ask for a lot of money, because there's like this magic thing that it happens is that you usually see rounds that they don't take up more than 25%. So obviously if you get too low, like I'm not saying sell that percentage of your company for like $100, but yeah, ask for 100, ask for $1 million. And that if you can get people to agree to give you more money, like that usually ups your valuation. I had one client who did that. They went out with a deck to a VC firm, and it was a $500,000 investment. And they were gonna, theoretically, that'd be like a pre-money of like 1.5. I said, whoa. They don't wanna invest just $500,000. Like, what would you do with $2 million? They're like, Ryan, we don't need it. I'm like, what if $1.5 million just fell on your desk? You have to spend it. Like, what would you do? You're like, oh, okay, I can figure that out. They got like $1.8 million, and the valuation went up high. So that's the only real way. I mean, other like random stuff doesn't matter. It's like, be awesome. I don't know. Like, just convince. But there's no like algorithm. I know people try to say like, well, if you have like one founder who did a PhD, that's $500,000, and no, like all the algorithms are just sort of fun, but not real scientific. You were next. Yeah, I just say like keep being persistent, and like an early no doesn't mean no forever. Like a lot of the good investors that we represent, like one of their big things is like persistence, because they know in your company eventually like the shit's gonna hit the fan, and they want to know what are you gonna do when it does. And if they see somebody come in a little early and just kind of give up, that can be bad too. And so I say start from the very beginning. There's nothing wrong with saying, hi, I'm X and I'm doing this, and we might be a little early, but I just want to introduce myself. That allows you to come back 3 months, 6 months. You can sort of hopefully back up what you said you're going to do. That's a little bit of proof that you're actually going to back up your promises to them, or promises to what you're doing. So as far as like finding, AngelList, like scour all the accelerators and all the people coming to these things. A lot of like the family offices in town don't have like websites, but just the more you keep out there and keep sort of pitching it, I think you sort of get in, and just ask other entrepreneurs. Like, they're really, or if you see people get funded, just ask them. Like, who do you talk to? Do you have like an old list of people you talk to? They might be able to share some of that. So it's a pretty giving community, or it's a really good paid forward community, like anyone, in Dallas especially. So, you know. Okay, yeah, go ahead. You're next. Yeah.
There's a lot of talk about out of the box, getting too high a valuation to go through your next round.
Yeah.
You can't back it up in terms of there's not enough. It looks bad if you don't have that much growth between C round and A round, where you're matching that valuation that you had before.
Yeah, I mean, to me, it's like, what's the degree of extra valuation, right? If it's like you're coming with a valuation of like 6 million, and your investors want, it should be 4.5, you're really like not that far apart. If you actually break down like what the percentages are based upon their investment amount. But I agree, like it could be a problem where if you can't raise like a round higher, it may trigger some anti-dilution, but usually it's minimal, to be quite honest. Obviously, they're not like very enthused about it. They may have some protective provisions upon that round, but at the same time, that also gives you like some leverage to get the higher valuation of the next round. Like, we have to raise above this, and it's usually not that much more. So it depends. I mean, if it's like, 5 and 15, that's a big deal. If it's 6 and 8, whatever, you and then you. Yeah, I got you. Oh yeah. Yeah. Part, what was the last part? Well, I mean, I think technically you have to have like one person on your board of directors to have a valid corporation. The way I say that is at the early stages, like the founding team should really be the ones dictating like what is the path of the company. Because do you really want like 4 outside people to dictate whether you guys should pivot before you've had like a huge launch? No, that's not a great discussion, right? But what I did mention like advisory board members. Now, these are people, they call it a board of advisors. It's definitely not formal. These people have no voting rights for what you want to do. But I don't even know why it's called a board, because they never meet at one time too. It's just a group of people that you just have as, sort of it's like a graduated mentor who you've decided to have, typically an advisor agreement with, maybe a small percentage of options in your company. But they're more of like a sounding board. They can give you like strategic contacts, help with some funding potentially, I don't know. But yeah, I think it's good to have that, but sort of like a board, like don't go overboard on it. I see like, here's our 12 advisory board members, and then you just look like you've created a new website for like Tech Wildcatters or like the Deck or something, all their mentors, so don't do that. Not that they can, they can do that, but don't do it as a startup. So, yeah. Was there one more? Any questions? Are we close to timeout? Yeah, one more, and then you. Yeah. Yeah, so I think one thing you do, I forgot you, right? Sorry. I think you don't just raise here. Like we have a, don't just, start here, try to raise here, but go coast to coast, go international. We have clients that are in Dallas, they have money from Europe, they have money from Asia. Like, don't limit yourself. Like from a geographic standpoint, it is like a hunt. You have to be very persistent about it. But I was trying to say more the mentality, like if you are raising here, you can get really beat down by it because you hear a lot of no's. Like I used to joke, like if you want to start just practicing your pitch, just go to like all the angel groups in town. They'll tell you no, and it's amazing because you're not, you didn't make $1 million in like EBITDA or however they say it, like last year. But yeah, I don't know. I mean, you can talk offline about it or shoot me an email or on Twitter about it. But was there one more? Do we have time? Okay, that's it. I'll be outside for a little bit if you want to talk more about it. Yeah.